Welcome students in this edition of live virtual classes batch 2 for the paper Advanced Financial Management. ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Student, in this series, we have covered almost all the topics. Now today we shall take up the two topics that has been left over, that is merger acquisition and corporate restructuring and startup finance. So today, in today's class, students, uh, CA Divas Gupta sir will take up this both the topics, and as usual, the floor will be open for you in the last 15 minutes. And meanwhile, even you can send your queries in the chat box. So, student, with this, we start our lecture for the today's session. Divas sir, now you can start. Thank you.
Sure, sir. Thanks a lot, sir, for the opening remarks. Good morning, everyone. So today we'll start with a discussion on the mergers, acquisitions, and corporate restructuring, and then we will go to the startup finance. To start with, students, on mergers and acquisitions, we have to first understand what are the different types of a mergers and acquisitions. Or in other words, how can different arrangements lead to mergers and acquisitions? So the first type of arrangement is where, let's assume there are two companies, company A and company B. Now company A is a company which before merger and after merger it continues, but company B dissolves itself and it merges into A. So company B loses its, or let's say it gets liquidated and it gets combined with company A, and now company A will take it forward, the business of both A and B. This is the most common form of merger, students, wherein the one company loses its identity and it merges into another. The second type of merger and acquisition is, if we focus on the word merger and acquisition, so the second word is acquisition. So acquisition means we are purchasing what? Purchasing the majority stake. So let's say there is a company called A and there is a company called B. A acquires majority stake in B Limited. That is called as acquisition, wherein A will become the holding company and B will become the subsidiary company. Correct? So this is one form of mergers and acquisition. So the first form was pure merger, right? The second form is pure acquisition. And in this case, both A Limited and B Limited, I'm talking about case 2 here, students. In this case, both A Limited and B Limited will continue to have their own legal identity. There is no dissolution, there is no liquidation of either A Limited or B Limited. Okay, it's just that the control of B Limited rests with the holding company called A Limited. Now let's come to the third form of mergers and acquisition. Now students, whenever we discuss about mergers and acquisitions, it is not only combining the entities, it is even demerger that is part of mergers and acquisitions, or you can say corporate restructuring, because in a way it is changing the way you structure your company. For example, in the third case, let's say A Limited is a company and it has two businesses, business 1 and business 2, right? So what they do is they continue to do business 1 in A Limited. For business 2, they open up a new company called B Limited, this one, and hence they transfer the business of B2 from A Limited to B Limited. The moment they do this, a new company gets formed and in that business comes in. So here what has happened? A company has gone into two companies, which is A is now A and B put together with different lines of business being operating there. So this form of merger and acquisition is called as demerger, where demerging is happening between the two different business segments. Clear, students, till now? Perfect. Now, the fourth form of merger and acquisition is where both A and B will get dissolved and they will form up a new company called C. So there are two different companies, A and B. Both of them will get dissolved and they will form up a new company. Okay. Now, students, let's get into the first case in detail because that is the most common type of merger that we were discussing. Okay, before we go there, there is another form of merger that happens wherein I'll tell you in practical life this happens a lot. Let's say there are two companies, A and B. Okay. Now, A is actually a company which wants to acquire some business. Okay. So A wants to, let me do one thing. Let me put it in a separate sheet so that there is enough space. Yes. So we are talking about here fifth form of merger, students, wherein A is there and B is there. Now B is, let's say, into different businesses. Let's say business 1 and business 2. Now A Limited wants to acquire only business 1, this one, without taking over the company. Now A Limited wants to acquire only business 1 because this business and the business what A Limited is doing is of the same nature. Okay, is of the same nature. For example, A Limited is making perfumes and B Limited business 1 is of perfumes and deodorant, or let me say only deodorant. And business 2 is of soaps, for example. Okay, they make soap, they sell soaps. Now if you see, perfumes and deodorants are of a similar category and hence A, for increasing its market share, is desirous of only purchasing the business 1, which is deodorant, because if it happens then they will be leader in perfumes and deodorants category. Now what will happen? They can't ask B Limited to merge itself with A Limited like in case 1 and hence B Limited will get dissolved because B Limited is also having a separate business of soaps. So what A Limited will do, A Limited will pay purchase consideration. We will discuss what is exactly meant by purchase consideration. Okay. So A will pay the amount on account of which it is purchasing the business 1 from B, and B will sell only business 1. It will only sell business 1. So there will be a business transfer agreement between both A and B, wherein B will sell only the business to A, and now A will acquire the entire deodorant business from B. Okay, students? So this is another form of merger and acquisition because it is a merger of business, right? While we will go through further, we will discuss about sell-off. So this is a sell-off from B's perspective. Sell-offs from B's perspective because they are selling their business unit or their major assets. Okay, clear? So this is another form of merger and acquisition wherein only business is purchased, and after this purchase, A Limited and B Limited, both of them will continue as a separate legal entity. There is no issue with that. Okay. Now, next one. If let's say A and B. Let's take an example of our case 1 wherein B is getting dissolved and it is getting merged into A. So then we have a purchase consideration. Now, what do we mean by purchase consideration, students? So purchase consideration is typically the amount that has been fixed for any sort of a merger and acquisition. Now, wherein B is getting dissolved to A, students. Now tell me, A will pay that consideration to whom? Since B is getting dissolved and it is getting merged, so A will have to pay that consideration to the shareholders of B Limited, who are the real owners, because they are foregoing their equity interest in B Limited, and they will expect the purchase consideration to be paid by the acquiring company, which is A. Okay, and hence the in most of the cases the purchase consideration is discharged to the shareholders of the target company. Now, purchase consideration also can take multiple forms. The first form is wherein the equity shares of A Limited will be issued to the shareholders of B Limited, wherein now let's say A Limited is purchasing the equity shares of B Limited from the shareholders, and it will issue its own equity share to B Limited's shareholders. So, for example, let's say A Limited is acquiring one share of B Limited. So, in exchange of that, A Limited will issue its own equity share to B Limited's shareholder, so that B Limited shareholder is now the shareholder of A Limited, where the business of B Limited gets dissolved. Or later on, shareholder of B Limited can even sell the shares of A Limited and make profit. Okay, so the first very common way of uh, merger and acquisition is the issue of the equity share of A Limited to the shareholders of B Limited, right? But for this, there are some complications that we will discuss. Now, second point is the cash payment, students, wherein right outright cash is paid to the shareholders of B Limited, wherein by cash payment we doesn't mean that it will be paid in hard cash, but it will be through a bank transfer. It will be through the bank mode, right? But it will necessarily require outflow of the resources, right? Then the third option can be mix of one and two, wherein combination of equity shares of A Limited plus cash payment will be paid to the shareholders of B Limited. Now, the this question is answered that what is purchase consideration, how it is discharged. Now the third question comes, how it is calculated. Okay, what things goes into account while calculating the purchase consideration, because what is the right value? B Limited will always want value to be higher. A Limited will always want value to be lower, right? But at what price the deal will strike depends on lot of factors. Okay, so the first part of how is the swap ratio. What is the right swap ratio, students? Okay, first of all, what do we mean by swap ratio? Swap ratio is how many shares of A Limited will be issued against every share of B Limited, where A Limited is the acquiring company and B Limited is the target company. So in our entire discussion, students, let's say A Limited is desirous of acquiring, right? So it will be acquiring company, and B Limited will become the target company. Okay. So what number of shares for A Limited against every share of B Limited. This is called as swap ratio because at what at what, let's say, number of shares are we swapping the amounts? That is called as swap ratio. Now, how to calculate the swap ratio? So in this case, what we do, we first of all estimate the A Limited's equity. Okay, A Limited's equity, then B Limited's equity. By equity here we doesn't mean the debt also. So we have to only value equity because, as I said that in our previous session, business valuation is something different, but the equity valuation is something different, students. Correct? So business valuation is the entire business value, what business is fetching, that includes even the debt component. But equity value is only the equity value. So then once the equity values are computed for both A Limited and B Limited, then swap ratio is calculated. Now, how swap ratio is calculated? I've tried to list down all the possible KPIs on which the swap ratio is calculated. For example, swap ratio based on the market price per share. Okay, this will be market price for B Limited divided by market price for A Limited, students. Okay, this is market price based. So in a way, market price for B Limited is coming in the numerator and the second one is coming in the denominator. Then similarly for EPS, EPS of B Limited divided by EPS of A Limited. Even EPS can act as the swap ratio indicator. Okay. Now book value per share. So book value per share of B Limited divided by book value per share of A Limited. So in a way, if you see MPS, EPS, DVPS, these are all measures of how financially strong company is. Better MPS means higher. So let's say if the target company is having a higher MPS, then they will expect higher number of shares, right? In terms of the swap ratio. If EPS is better of B Limited, they will expect higher number of shares. If book value per share is also higher, they will expect higher number of shares. Similarly, if all these three are lower, the A Limited will pay a lower swap ratio. Correct? This is very logical and very simple. Now, the fourth part is actually gross NPA percentage of. Now, there is one question actually which is related to the bank. Okay. So what do we mean by NPA here? Non-performing assets. These are those assets where they have already passed the timeline, which are what are prescribed by RBI for being a non-performing asset. But here, if you see, the equation is reversed, right? Because if we have a higher NPA of B Limited, which is the target company, we will end up paying lesser swap ratio. Correct? So if you have a higher NPA for B Limited, then denominator will become higher. The moment denominator will become higher, swap ratio will become lower. Correct? So this is the relationship because of which we have kept it in a reverse manner. So this is a point to understand. So if there is some negative, KPI, then the formula will get reversed. So that means the target company will come in denominator and the acquiring company will come in numerator. Okay. So these are some of the ways to calculate swap ratio. Now, interestingly, lot of questions will ask you to calculate swap ratio based on any of these 3 or 4 parameters that we have discussed. However, some questions will tell you to assign some weightage. let's say to market price per share, you assign a weightage of 60%. EPS, you assign a weightage of 20%. Book value per share, you assign the weightage of another 20% to make it as a overall 100% students. In such a case, what will happen? In such a case, you will calculate the individual swap ratios based out of MPS, EPS, and BVPS. Then you multiply them with the respective weights, which is 60, 20, 20, and finally, you will arrive at an overall swap ratio, students. Clear? I'm just checking any queries till now. Okay, because what they feel, some taking some average will be better compared to only relying on MPS or EPS or BVPS. Okay, NPA is a bit different case, it's only applicable for the banks. Now, all of us know price earnings ratio was what? Price earnings ratio is price divided by earnings. There is one question from Abrikesh. Okay, now Abrikesh is asking if the question is silent, if the question is silent, which one we should apply? Okay, let me tell you. If the question is silent, Abrikesh, just apply whatever details are given to you. Sometimes, let's say if the question is silent, but they have only given you MPS, so you have to apply with MPS. If the question is silent and you have given all the relevant details for EPS, then you apply EPS. Similarly, BVPS. Okay.
Shiva sir, I want to add something here.
Sure, sir.
In case,
Sure, sir.
I don't think there is any type of a question where is question is silent because some basis has to be defined. Okay, because generally questions are concentrated on what are the gain to a one company, loss to another company, like this type of a question.
Right.
Moreover, is there any ambiguity in the question? Then you can opt for any option. Okay, in that case, we assume that either you can exchange based on the your market price or on EPS. So in both the cases shall be acceptable and both alternative solution will be there. So student need not to worry about the same.
Perfect. Thank you,
Okay,
sir.
thank you.
Thank you. Thank you, sir. Okay. Now let's come to EPS, which is earnings. So EPS, we all know but this is just a formula that we have put because in questions they will start, let's say, earnings, the PAT. Then from that we have to arrive at the earnings attributable to equity shareholders divided by the number of equity shares. Now, some of you might be thinking we have mentioned earnings attributable to equity shareholders. This is something that has to be arrived from PAT after reducing any preference shares related costs, right? So that is there. Then this is very, very important. This entire part is important because the questions are actually revolving around these. So in a way, okay, now let me tell you, in entire mergers and acquisition, students, the things that we have to study is, first of all, to understand what is the correct swap ratio, right? What is the correct, let's say, transaction price of that mergers and acquisition. Now that will be arrived through swap ratio. Swap ratio, there are different forms that we have discussed. Now, once the merger and acquisition has happened at that swap ratio, what we determined, after that, we have to also analyze that post merger, whether the merger is beneficial from the A Limited's perspective or B Limited's perspective or from both the companies' perspective. Okay? Because it might happen that both the companies have gained after entering into that merger and acquisition phase. Okay? Now, for that, again, we have to calculate post acquisition or post merger what are my KPIs. By KPIs, I mean again EPS, MPS, all those things, right? So in this case, we are showing you the formula for EPS after merger, or we also call it as a post merger EPS. Okay, now if you see, there are different ways we can discharge a purchase consideration. First, let's talk about the case where the payment has happened through shares settlement. The payment of purchase consideration has happened through shares being issued by the A Limited. So what we will do, how is EPS calculated? In that we will take the PAT of A Limited, right? Then we will also add PAT of B Limited. Why we are adding PAT of B Limited? Because now that company is merged. B Limited is merged into A Limited. Then there is this term called synergy gain. Okay. What do we mean by synergy gain, students? So synergy gain is actually coming from the very basic objective of a merger and acquisition. Now, synergy means that if you combine A Limited and B Limited, so their combined profit, or let's say their combined potential to earn profit, will be higher than what individual summation of A Limited and B Limited will result into. So we denote synergy as so value of A and B Limited put together will be higher than value of A Limited plus value of B Limited in a separate manner. Now this is the merged entity, and this both of them are individual entity, A Limited plus B Limited. Now the question comes why it happens. Okay, so a lot of us know that there is a synergy, but why it happens? There are multiple reasons to it. So I will tell you one of the reason, right, which is a major reason. So what happens, students? Just a second, I think. Yes. So what happens, students? B Limited has its own governance structures and has its own overheads because of those governance structures. It has, let's say, separate board of directors. It has, let's say, separate management. It has to have, let's say, separate, I would say, supervisors, right? It has to have, let's say, other oversee functions, or let's say other support functions, right? Support functions, let's say HR, finance, other departments. Now what will happen the moment B Limited merges into A Limited? So lot of these repetitions will be taken out from that merger from for B Limited, right? So I would say, let's say, this board of directors definitely not needed because A Limited would already be having their board of directors, right? Management to some extent will not be needed separately of B Limited into A Limited. If there are some specific functions, only those will be needed, right? So everywhere there will be cost optimization, right? Cost optimization means since all these layers will go down from B Limited while getting into A Limited, so their combined profitability will definitely be higher, right? Second, second reason. So this is the first reason, right? The first reason is the structures correction, or let's say the elimination of excess structures that will lead to some benefit in the synergies. Then the second reason for this is definitely the economies of scale, or let's say the demand concentration, or let's say the market share winning. Because what happens in a combined manner, they will have a higher market share, for example, because they both of them, let's say, are into the same product line. So in a way, they will be able to generate higher revenue because now their position in the market is consolidated. Okay. So this is why there is some synergy, right? Because there is some cost cutting that happens, there is some optimization that happens, and then from a business perspective, there is some consolidation that happens, whether it is production capacities, whether it is demand, whether it is marketing, whether it is anything, right? So this is why synergy comes. So that's why we say that part of A and part of B is not actually going to be a part of the new company. It will be after adding your synergy amount as well. Now this we will divide it by, now since we are calculating EPS, right? EPS is divided by the number of shares. Now here the number of shares for A Limited are already issued, the existing number of shares. In that, we add equity shares issued to the shareholders of B Limited. Since we are talking about the case where share settlements has happened, hence what we are doing is we are adding in this the equity shares that are issued to the shareholders of B Limited. Correct? So that becomes the revised equity shares issued of A Limited, right? Because even these shares are appearing as the equity shares issued in A Limited's books, correct? So A Limited post merger will have profits from B, will have synergy gain, and in the division, it will have the new equity shares issued to the shareholders of B Limited. Clear? Then, if we are discharging the purchase consideration through payment of cash, that can also happen, right? Now, the moment you pay cash, students, you end up losing the opportunity to earn interest on that cash, right? Because now you're investing that cash in the merger and acquisition. Had you not invested in that, you would have invested it somewhere else where you would have got some return. And second thing, in all the theories, mostly you will see, let's say in derivatives also we have studied, wherein we talk about the hedging part, right? Or let's say the speculation part. We always assume that the company is neither having excess funds, or if it is in want of the fund, then it will borrow, right? So that is the preliminary assumption that we take. So since the company here is not having any excess return, so we are assuming excess cash. So we are assuming that it will forego the interest that it would have earned on the investments had they kept it. Okay. There is another thing, students. What companies do today is they borrow and they purchase a new company, that we will study in leveraged buyout, LBOs, right? Have you heard of the term leveraged buyout? In leveraged buyout, what happens is the payment happens in cash, but the source of arranging that payment comes through a financing mode, comes through a borrowing mode. Okay, so the company who wants to purchase the target company, they will take a loan and then they will discharge the payment purchase consideration. Now, in that case, your overall PAT that we have added, A plus B plus synergy gain, will get reduced from either the opportunity loss, right? Either the opportunity loss or the borrowing cost, right? Whatever can be the case. Yes, Abrikesh, you're right. Okay, so the cash paid into return percentage into 1 minus tax rate. Since we're talking about PAT, hence the tax has to be adjusted. And in the division, only the current existing shares of A Limited will come, students. Nothing else will come, because in this case, we have not issued anything to the new shareholders, right? So now we have understood how to calculate the earnings per share post merger and acquisition, right? In case the shares are issued, we have to take into account the fresh shares. In case the shares are not issued, we have to take into account the opportunity loss for the amount that we have invested, or any sort of a borrowing cost if in case we have borrowed and paid it. Okay. Now, this segment, this new discussion of effect on EPS post merger is actually dependent on the EPS being calculated post merger, right? First, you have to calculate the EPS post merger, then only you can calculate the effect on EPS post merger. Correct? Now, while we talk about any effect, students, right? Whenever in the entire subject, whenever we talk about any effect, so we have to compare two things. One is the transaction happening post that effect, and the transaction happening pre that effect, right? Now, what is the effect here? Effect is the merger and acquisition, right? So the event here is the merger and acquisition. Now, that event's effect on EPS will be derived by if we compare the pre-merger EPS and post-merger EPS. Now, for A Limited, it is very simple. So acquirer company A Limited. Post-merger EPS is what we have calculated above. And then this is a pre-merger EPS, and hence the net impact on the acquirer company. Okay, now for example, the post-merger EPS is 10. Pre-merger EPS is 8. That means 2 rupees has increased in the EPS of the A Limited. Simple and easy. Now for B Limited students, this is a tricky one. Tricky and important one. So what is happening here? We will take, now there is no legal identity of B Limited, right? B Limited has been dissolved now. The moment we say that B Limited has been dissolved, so now post-merger EPS of B Limited, how are we going to calculate? It is easy. The post-merger of EPS related to B Limited's investments can be calculated by, you just simply need to take the post-merger EPS of A Limited, and that we have to adjust for the swap ratio. If in that you multiply the swap ratio, you will arrive at the post-merger EPS equivalent amount for B Limited's investments in the A Limited. I mean B Limited's shareholders. Okay. And because pre-merger EPS B Limited was existing, and hence we have the data for B Limited's pre-merger EPS, that we will reduce it from here, and hence the net impact on the target company shareholders is this much. The difference between two. So clear students, why we have adjusted for the swap ratio? Because one share of A Limited post merger is not equal to one share of B Limited pre merger. You can mention this line because this is very very important and a lot of mistakes happens here. So one share of A Limited post merger is not equal to one share of B Limited pre merger. Okay, students. Hence, to make it equal, one share of A Limited post merger is adjusted for swap ratio. It is just simply multiplied with the swap ratio to arrive at the one share of that B Limited equivalent number for the post acquisition business. Okay. Now, there is a term called value of acquisition. Now, what do we really mean by value of acquisition? Value of acquisition is from A Limited's perspective, which is the acquirer company, right? Which is going to acquire. Now, value of acquisition means that what incremental value has come to the A Limited, right? So, the way we will calculate is the value of the merged entity, right? The overall value of the total entity minus value of the acquiring company before merger, right? So what is the net increase in the value that has happened to A Limited because of the merger? Simple, right? Now somewhere we have to also calculate the gain and loss to the shareholders. Now if the question is silent how to calculate this gain and loss, we'll just make use of the market price per share. And like we did in EPS, we will also do in MPS, which is the pre and post merger amounts. Okay. So for example, MPS of post merger A Limited is what we will take, and we will reduce the MPS of pre merger A Limited. So in a way we are comparing these two and we are arriving at the gain slash loss. Simple. Now this is also very, very important because the shareholders would want to know, because of this deal, how much they have earned or how much they have lost. Because a lot of times the market price per share of the merged entity will not move in the direction that you desired post acquisition, right? So this becomes really very, very important. Then the second one for B Limited now. Now again we have to think it from the same logic. Whether one share, okay, what is that logic? The logic is B Limited is not existing post merger, right? It has already dissolved. Now, if we have to calculate the impact, or let's say effect, or let's say gain or loss, then we have to first arrive at what is the equivalent value of B Limited's in the A Limited's number of shares. So that we will again get by, we will take the MPS post merger of A Limited, and in that we will multiply the swap ratio like we did for EPS. Then from this we will do the minus of MPS of pre-merger B Limited and hence arrive at the gain or loss. Now the MPS of pre-merger B Limited is actually for one share, and MPS of post-merger A Limited adjusted for swap ratio will also become the equivalent of one share of B Limited pre-merger. Okay. So as I said that for both A Limited and B Limited, this merger and acquisition can prove to be a gaining situation where both A Limited and B Limited shareholders will gain. On the other hand, there can be some loss scenarios for one company as well, wherein let's say they are not able to fetch out a better deal. For example, A Limited has significantly reduced the purchase consideration. The moment it will happen, the B Limited's gain or loss, it will be lower gain or higher loss, right? Because now B Limited has got lower amounts, students. Perfect. Now these are another set of terms that we have to understand and keep in our mind. So one is market capitalization, wherein the market capitalization is a very simple term, wherein we take the market price per share, multiply it by the number of the equity shares that are issued by the company. Okay, for example, let's say the market price per share is rupees 1000, and I would say, let's say 100 crore is the 100 crore is the number of equity shares, and 1000 rupees is the market price. So the market capitalization will become 1 lakh crores. Clear? We have to just simply multiply 1000 into 100. Now, out of this, there is a concept called as promoters holding. Now, if you see any financials, in that also promoters holding needs to be presented. Now, what is this? Promoters holding is actually aggregate of the promoters' interest in the company. Okay. Why we separately see this? Because this much value is not held by public at large. It's not held by even the financial institutions. It is held by the promoters themselves. And hence the major decision making capacity also rests with them. In case, let's say, it is more than 50%. Okay. So promoter holding is 60%, or I can say, let's say any X percentage we call as the promoter holding. Now, in a lot of questions, this term is used, which is free float market capitalization. So herein we say market cap, the overall market cap multiplied by 1 minus X percentage, which is the promoters holding, students. Clear? Why it is called as free float? Free float means that each sale purchase can happen for such market, for such number of shares, right? Otherwise, it would have been difficult. Because promoters are not likely to sell or purchase these shares freely in the market. Okay, they will do it, but once they are willing to do it. Okay, it's not a free float. But rest other than promoters holding, it becomes free float. Now, for example, if 60% is the promoters holding students, 40% become the free float market cap. Okay. Now, again, these are the two terms that have come in from, I've taken it from the quotients only. So there is, let's say sometimes it can ask you calculate the true cost of merger. Okay, the true cost of merger. So see students, I'm talking about any commercial transaction in the world. Okay. Whenever you say in any transaction which is happening between two parties, if one party is a loser, second party is a gainer. Now, interestingly, today also, if you see, the share market is going up, and you are investing in that. Let's say today the share price is 1,000. Now tomorrow the share price becomes 1,200. Now day after another that day it becomes 1,500. Okay. Now still you are again investing at 1,500 in the anticipation that in the time to come 1,500 will give you benefit, right? At the same time, there is another person who is selling you at that 1,500 in the anticipation that the prices will not rise more than 1,500, right? So at on one hand, there is an expectation that the price will go up. On the second hand, there is an expectation that the prices will not move up, and hence let's book the profit at 1,500. So whosoever is selling it to you, he or she will book the profit. Now, what I'm saying is that in the entire commercial transaction, there is one party who gains and there is another party who loses, right? And typically, let's say tomorrow, let's say 1 month from now, the share price of the same case would have moved to 2,500. Okay. Now, can you tell me in this scenario, 1,000 rupees is earned by the person who invested at 1,500, and can I say the person who has lost 1,000 rupees, who's the seller at 1,500, in case they would have decided to hold it, they would have made another profit of 1,000 rupees, right? So is it an opportunity loss? Yes. So that is what I'm trying to say. That since there is a gain that has happened to the person who has sold, the cost of merger. So it is really the gain that is happening to the counterparty. Which is the counterparty here? B Limited, right? So if I say from A's perspective, what is the cost of merger, right? Which is actually gain to the shareholders of B Limited, which is calculated in this formula, right? Gain slash loss of B Limited, whatever this number is, if there is a gain, then we will say there is a cost of merger that has happened, and this cost is attributable to A Limited students, right? And here it is B Limited. Clear? Now, value of merger will mean that how at last how much gain has come to A Limited shareholders, and it has resulted into the value being increased, and hence this is a real value driver of the A Limited's profitability. Okay, or let's say not profitability but the market cap growth, right? Okay, so now if you see, we are clear with two, three things. One is what are the different forms and types of mergers and acquisitions. It also includes demerger in this case. Then how do we discharge the purchase consideration, right? How do we arrive at the purchase consideration? How do we arrive at swap ratio in the purchase consideration? In that, we came to know that wherever there is a positive KPIs, there we will use B Limited divided by A Limited. Otherwise, we will do the vice versa. with the logics. Then we also understood that if we have to calculate the EPS and MPS post-merger and pre-merger comparison we have to do between both the companies, then we will make use of the formulas that we discussed, right? In that case, we will adjust it for the swap ratio only for B Limited, right? Then we also discussed about the true cost of merger, value of merger, all those things, right? Now there are these some of the questions. Let us see. We will pick one or two, but let us do the concepts revision first. Then we will come to the questions. See, have mentioned. I think in this question they would have asked somewhere or the other. So value of merger is from the A Limited's perspective, how much value they are able to drive from the acquisition, right? And how we will be able to calculate that whatever uptick has happened in the form of gain to the shareholders, right? The uptick has happened in the form of gain by acquiring company in the merger procedure, right? Now, what is the cost of merger? Cost of merger from A Limited perspective becomes the amount gained by the B Limited's shareholders or the gained by the target company's shareholders. Correct? See, similarly here, if you see in this question, gain or loss to the shareholders of XYZ Limited, market price of the merged entity is this much before merger and loss from merger. Like this, the calculations are to the discussion part first. Nineteen. Yes. Now this comes the rationale for merger and acquisition, students. Okay. Now we have understood that how a merger and acquisition and a corporate restructuring is accounted for, or let's say calculated for, right? How do we do the calculations? How do we analyze whether that merger and acquisition is fruitful or not? Now let us first also understand that why there is a need for merger and acquisition. Rationale means that what is the real objective of achieving that merger and acquisition. The first one is actually synergy. This is what we have already discussed. So the new company, which is A and B put together, wherein B is merging with A, so that value would be higher than A and B individually put together. Again, because of the obvious reasons that we have discussed, which is, let's say, cutting down the structures, right? Getting economies of scale, production consolidations, market consolidations, share market gains. All those things will give you better benefits, right? Higher than the individual addition. The second part is actually diversification. So what happens generally in our portfolio management discussion, students, I will just relate it back there we discussed about two types of risks. One is systematic risk, second is unsystematic risk. So systematic risk is something at macro level which cannot be reduced, but unsystematic risk is at micro level which can be reduced through the process of diversification, wherein we are entering into the new age or let's say the different companies to the nature or inherent nature in which the existing company is. For example, A Limited is into FMCG and B Limited is into real estate. Both of them are purely diversified, right? So, to in a way to reduce the overall unsystematic risk, right, between A Limited and B Limited, so both of them will get into merger form or acquisition form by whatever name they call, and hence diversification becomes another bigger reason for as a rationale for the merger and acquisition. Now the third part is taxation. Now this is very interesting actually. So this taxation you will also study in your direct taxes actually, wherein there are specific rules and regulations that govern this. Now, what happens, students? Let's say there is a weak company, right? By weak company, we mean that it is not able to generate any profits, right? It has already accumulated losses with them. So, in a way, they are, and they don't have a site also by when the profits will be available against which these accumulated losses can be set off for claiming the tax benefits, right? So there is another company called strong company. They want to acquire weak limited company, and the moment they acquire weak limited company, by acquire means they merge into a limited into sorry strong company. Then what will happen? Strong company, if at all they are generating future revenues and profits, then they will be able to utilize this accumulated losses, which is unadjusted losses brought forward with the gains that the strong company is going to have, and hence they will be able to lower down their tax liability to that effect. Clear taxation. So in taxation also there are clear benefits in case the companies decide to go ahead with the merger and acquisition, students, right? And as I said that there are proper rules and regulations, which governs the taxation for mergers and acquisitions, right? So, I mean, what are the rationales for merger and acquisition? Synergy, then diversification, and then third one is the taxation, right? Now let's come to the fourth part. This is also very, very interesting. So, students, if I ask you, what do you mean by growth, basically? Um, we always kind of say that we also want growth in our lives, right? Companies also always says that company also wants growth, right? However, what is our understanding on growth? What is the layman's understanding on growth? So, growth is something that is incremental to the existing base, right? Correct. It is something that is incremental to the current base. That is called as growth. Now, if you see A Limited is already clocking a revenue of 1,000 crore, right? Now, it will, let's say, take a target of 10% increase in the sale, and to the maximum, it can reach out to 1,100 crore at any given point of time, right? Let's say in year two. However, in case they decide to acquire B Limited company, which is having a revenue of 600 crore, in the next year itself, after the acquisition, their overall revenue will show as 1,000 plus 600 plus 100 of the regular growth. So in totality, it will show 1,700 kind of a growth, 1,700 kind of a revenue. So which is a growth of 600 crore coming from acquisition, merger and acquisition, and 100 crore coming from the regular growth. Okay, students. So to back this growth, companies enters into the mergers and acquisitions. Now, if you see, there is a concept of organic growth and inorganic growth. You will hear these words quite often now. So, organic growth is something where the growth is coming from the regular business. Inorganic growth means the growth that is coming because of the acquisitions, because of the mergers. right? That is called as inorganic. Inorganic means which was not there in the base year, but you are acquiring it now. Organic is something that is there in the base year and you are growing into that. So 1,000 crore moving to 1,700 crore, out of that 100 crore is called as organic growth, which is on the business that was already appearing, and 600 crore is the inorganic growth, right? But what happens? Why this growth is a rationale for merger and acquisition? Lot of um, because in the financial world, right, the growth will drive your share prices, right? Whatever growth you are doing in your revenue, in your EBITDA, it will drive your share prices. So the moment you say that we have acquired some other company and it is going to have an income of 6 growth, so it will then called as the inorganic growth, and hence it's one of the rationale for merger and acquisition. Then fifth one, students, consolidation of production capacities and increasing market power. This is what something we have discussed, right? Wherein, let's say, there is a production capacities, right, um, between B Limited and A Limited. Let's say A Limited is super occupied and it has already fully utilized its production capacity. Right now, B Limited is underutilization, is it underutilizing its production capacity? Now one side there is a higher demand and second side there is a higher supply. So what they will do, they will get into a merger and acquisition wherein B Limited will make available its facilities to A Limited and hence A Limited can take it ahead, right? So this is called as the consolidation of production capacities. And increasing market power is wherein both A Limited and B Limited, let's say, are in the similar categories, right? A Limited has a market power of 60%, has a market share of 60%. B Limited has a market share of 10%. By market share, I mean that out of the total products of all the brands put together that are sold, how much products of A Limited are sold. Okay. Now, if you see, this all becomes 70%, A Limited and B Limited. Now, balance 30% are, let's say, very small investors, right? There are, let's say, thousands or 2,000s of investors who have collectively invest 30%. So what will happen here? It will increase the market power, right? Because of the consolidation, the production capacities, and increasing the market power is also one of the rationale for entering into mergers and acquisitions, students. Perfect. Now let's come to the different types and forms of mergers and acquisitions. Now, student, please understand it very carefully because this is very much needed. Right? How and I mean, what are the different types and forms of M&A? First one is the horizontal merger, students. So by horizontal, we mean like this line, right? Vertical means a standing line. Horizontal means a sleeping line. Now, this horizontal is something, if you see, okay, first of all, what is the meaning of industry? I think most of us know industry is a collection of companies having common set of consumers with a common need. You're getting my point? So first of all, the consumers needs to be common, right? Who are, let's say A Limited and B Limited are also, are both of them are in the same industry. Let's take an example of automotive industry, right, which is specifically catering to the four-wheelers and two-wheelers, and the bigger trucks, right? So in that case, all the companies that are in the automotive sector or industry, we will say that all of them put together in collective manner represent the industry, right? Now, if the merger and acquisition happens between two companies of the same industry, then it is called as a horizontal merger. Okay, so the A Limited and B Limited, both of them into the same industry, and if they plan to get merged or plan to get acquired, then it is called as a horizontal merger. Clear? So this is what I've denoted here. It's at the same level, basically in the same industry. Now let's talk about vertical merger, students. So vertical merger is something where, let's imagine a company is this A Limited, and it has some vendors and it has some customers. So from vendors it takes the goods, and to customers it sells the goods. Now if you see, for A Limited, if it wants to purchase the goods, it has to contact to the vendor. Vendor will charge their own profit margins, or they will have their own differences with what compared to A Limited is, and it will also lose. A Limited is also losing, or any which way is extra paying the margins to B Limited, which is what needed. Right? So what will A Limited think? A Limited will go and ask B Limited for the merger and acquisition. So B Limited, if it gets merged into A Limited, and in this entire thing, A Limited will gain. Why? Because now A Limited procurement cost will come down from the vendor. So this is called as a vertical merger, because vertically the merger is happening in terms of the structure. And if we merge vendor with us, we call it as a backward integration, because in our supply chain the backend team is getting integrated, the backend vendor is getting integrated. However, for A Limited, if it talks to a customer that whether can you get merged into me, right, I will pay you this much of consideration. For example, this C Limited, this customer is the biggest customer of A Limited, right? C Limited is the biggest customer of A Limited. Now, what will happen? This will act as a forward integration. If C Limited decides to get merged into A Limited, this will act as a forward integration. Both forward integration and backward integration are called as the vertical merger. Okay, now in case let's say forward integration happens, C Limited will get dissolved and it will get merged with A Limited. Now A Limited will handle all the customer related functions as well, what C Limited was handling earlier. Similarly, once vendor gets integrated with A Limited, B Limited will get dissolved and A Limited will themselves take care of the acts that are done by the vendor. Okay, this is called as vertical merger. Okay, wherein customers and vendors are merged. Horizontal merger, two companies in the same industry. Okay, Abrikesh is asking what is the advantage in case of a forward integration. There can be commercial advantages, Abrikesh, right? Because ultimately what is happening, you are paying margins to customers, right? Because customers is not doing that activity for free, they will be charging some margins, right? They will be expecting some income. Now that part, if A Limited is taking care, even the income or margins will get consolidated with A Limited, right? So as I said that there can be a commercial objective, right, for the customer integration. Okay, because let's say I'm selling any goods to customer, right, and then customer is selling it to a retailer or let's say to any other person by keeping some or the margin. So if I eliminate that customer, I will get even the margins from that customer. Actually, this happens a lot. I'm telling you, this happens a lot in the market, and even horizontal merger is a very plain form of a merger. Now, conglomerate merger, students. Conglomerate merger is actually wherein, okay, first of all, we need to understand what do we mean by conglomerate. So, conglomerate is one big group, right, which has running, which is running different businesses, and all those different businesses has no relationship to the other businesses. Okay, and what is the rationale for this? Because they want to have a diversification with them. So A Limited is unrelated to B Limited, and if they merge, that is called as conglomerate merger. So they are not from the same industry, not from same industry, nor are customer or supplier. Okay. So in that case, they will become the conglomerate merger. Co-generic merger, very, very important. Co-generic merger, students, where the generic nature is same. Why it is called as co-generic? Because the generic nature of the business of A Limited and B Limited is same. It's not that they are exactly into the same industry. Okay. What all factors will tell us whether their generic is same or not, whether they belong to the same generation or not. So the first is either they are into the same industry or some factors are common. Which are those factors? Let's say they are using the common technology, right? They are using the common technology. Second, they are using the common distribution channel. By distribution channel means how the products gets delivered to the consumer, or they have some kind of a similar product line. So what all things has to be common? Either they need to have a common distribution channel, common, let's say, product line, some or the other common factors, for example, technology, process, right? All those things will give you the co-generic merger. Now, this is a very good example that we have taken, students. A Limited and B Limited, wherein A Limited is an NBFC, B Limited is also an NBFC. Now, this A Limited NBFC is actually into the auto loans, and B Limited's NBFC is actually into the credit card or personal financing. Now, if you see, they have different set of consumers, right? Auto loans is required by them who are having the need to purchase a two-wheeler or four-wheeler. Okay, just a second now. Abrikesh was asking what is the advantage in case of a forward integration. That is, I think we have discussed that. I'm just looking at the queries if they are okay. Nothing as such beyond that. Perfect. Okay. So what I'm saying is this for co-generic merger between A Limited and B Limited, A Limited is in the business of giving auto loans and B Limited is in the business of credit card or personal financing. Now the set of consumers are very much different, right? So can we say there are different consumers, right? But they are into the almost similar industry of giving loans, and both of them are NBFCs. However, they the channel through which they access the customer is through agents, right? Because they are selling their loans through agents. They have kind of a similar product line, so hence we call them as a co-generic merger, because the generation, or let's say the generic, is same. It is of the same generic, right? That is how we call it. So horizontal, vertical, conglomerate, co-generic. Now let's come to reverse merger. Okay, so reverse merger we will discuss subsequently. Acquisition. Acquisition is something that we have already discussed, right? By acquisition, we not only mean acquiring the exact majority stake, it also means that if we control the decision making or the board of directors of the company. Now let's come to students reverse merger. Now reverse merger, students, is something. Yes, Abrikesh, because both of them are unrelated. You're right. Okay. Now, what I'm saying is, in case of a reverse merger, yes, if you see the general trend is where the large company purchases a small company. This is a general trend. Generally, it happens like this, wherein the large company purchases a small company, large company is the acquirer, and small company merges with the large company. Now, in case of a reverse merger, a private company, which is a small company, and public company, which is a large company. So private company acquires, or public company gets merged into the private company. Okay. Why? Because this public company, public company has higher accumulated losses, right? And there is there are no chances that public company will be profitable going forward. However, this private company, since it wants to go as a public company, what it will do, it will directly ask the public company to merge into the private company, and in a way it will get itself converted into a big company. The private company acquires a or I can say a small company acquires a big company. And since big company is a public limited company, private limited company after merging also gets listed. So it actually, it's bypassing all the requirements that are needed for getting itself listed as per the SEBI, right? Through this reverse acquisition. Okay, and hence lot of companies will prefer this. Okay, so in reverse acquisition, the small company is acquiring big company, right? Yes. Now let's come to divestiture. First of all, what is the meaning of divestiture? Divestiture means selling any assets or group of assets or business, right? Why we are selling it and why there is a need to sell? Because we want to concentrate on our core business. That is the only rationale that we can think of, right, for selling the assets. Now, what are the different types of divestiture? Even divestiture is part of the corporate restructuring, mergers and acquisitions, right? The current topic. So first one is the sell off or partial sell off, students. See, I have discussed with you the fifth example, right? How merger and acquisition happens, wherein I said that A Limited was in perfume business, B Limited had two businesses, one was deodorant and second one was soap. So now this perfume and deodorant will get merged by B Limited by selling business one and A Limited by purchasing business one. So that happens through slump sale of the business. This we call as sell off or partial sell off from the point of view of B Limited, students, right? Spin off. Now, spin off is actually, let's say, A Limited is again having two business one, business two. For business two, A Limited floats a new company called B Limited and transfers that business to B Limited. And the shares of B Limiteds are issued to the shareholders of A Limited, because now the share price of A Limited, the moment it transfers its business, will drop significantly, right? To make up for that loss, the B Limited shares is issued to the shareholders of A Limited. Third one, we call it as split up. By split up, what happens here is the different companies gets formed from a single company, and that single company gets dissolved. So split up means we are splitting up, right? Splitting up into the new and the different companies compared to the existing company. Then comes equity carve outs, right? In equity carve outs, the spin off happens, second stage, plus issue of equity shares also in the market, right? That is called as equity carve out. And in case of a family managed businesses, because if you see in India, there are a lot of businesses that are family managed. So if there is a demerger or there's a division happening of that family managed business, that also comes under the divestiture. Perfect. Now let's come to financial restructuring, students. Now, financial restructuring is a process in which there is a sick company. Sick company, we mean a company which is not good on paper, not good operationally, and it is having accumulated losses. Their accumulated losses are even higher than the share capital that they are holding. And years they have incurred losses. They have negative net worth in a way, right? So those are called as sick companies. Now there is a plan for revival pertaining to them. Now, how can we revive? See, there are different ways and means by which the revival can happen. One is, at the first case, we have to do the um, at the first case we have to do the let's say different sort of restructuring. For example, we have to reduce down the equity shareholders paid up share capital, let's say from 10 to 5 rupees. We will reduce it simply and say that it has gone, it has lost. Similarly, loans or borrowings agencies who have given us loans, we will ask them to reduce the rate of interest. Third is, in if let's say any loans can be converted and we can avoid any cash payment obligation that might come. Now, for working capital, we might ask the vendors to, let's say, forego some of the payments. Let's say, like we have also suffered a bad debts losses from that. Let's say some part they can forego. So there is a proper plan of revival that has to be made for the restructuring, because first of all, restructuring means that you are putting up a fresh structure to the entire part, right? So that is where the financial restructuring comes into play for the sick companies. Now let's come to the ownership restructuring, students. See what happens. One is that within the company some restructuring is happening, and second is the person who are owning it, whether they are at a public at large, whether they are a private limited company, whether they want to change from private to public or even public to private, that is called as ownership restructuring. Or let's say some other people has taken over as the owners of the company, that is also called as the ownership restructuring. Now in this case, the first part is going private. By going private means the public company which is already listed decides to go back to the private company. How? It will purchase the own shares from the market, right? And hence they will become a private company. Lot of companies do. Then second is management buyout. So management buyout means whosoever is the management of the existing company, right? Let's say whosoever is managing the day-to-day affairs, they themselves becomes the owners of the companies by getting the shares, right? By purchasing the shares. So the management themselves will now act as owners of the company. That is called as MBOs, management buyouts. Okay. Then third is leverage LBOs, leverage buyouts, the one that we discussed today, right? Wherein we have taken a borrowing to discharge the purchase consideration. That is called as the leverage buyout. Why are we doing that? Because if we take a loan on that, we will end up getting benefits on account of interests, right? And some of the tax related benefits. So that is called as leverage buyout, LBOs, right? Leverage means because we are leveraging the borrowings to purchase the company or hence to discharge the purchase consideration. Now, equity buyback. So, equity buyback is just simply buyback from the open market, because a lot of companies are doing equity buyback. They will announce, let's say, they will buy back this much of shares, right, at this much of price, which is definitely at a premium, right, from the market. And whosoever is interested, they can go and sell those, shares to the company. So, in this case, also there is a ownership restructuring that is happening, right, because owners are moving away from the public to the company, because now company will, after buyback, it will cancel the equity shares that they have issued. Now comes the next one, special purpose acquisition companies. These are very, very important, students. What happens for a special purpose acquisition company? So as the name suggests, first of all, they have a special purpose. What is that special purpose? That special purpose is to act as an acquisition company. Acquisition of what? They deal with the acquisition of new company, or any other target company that they are studying. So, students, one more thing. See, it's not that today we decide that we have to purchase a company and tomorrow we find that company and day after tomorrow we pay the amount and purchase the company. It's never like that. It's a very long run process which involves careful due diligence, which involves careful dealings, which involves lot of things. Any merger and acquisition deal typically takes 1.5 to 2.5 years to close from the initiation, right? It's not a very simple deal. So, with that background, if let's say the timeline to purchase or to finalize a deal is 1.5 to 2 years to 2.5 years, I'm just telling you a rough range. In that case, this special purpose acquisition company enjoys a very good advantage, because what they will do a IPO today. IPO is initial public offer, right? For going listing, right? They will raise the funds from public at large today. Whatever funds they raise it, they will keep into an escrow account. Okay, they will keep into an escrow account or in a trust based bank account, right? As it is mentioned here, this SPAC, Special Purpose Acquisition Company, launches an IPO, and they will put all the proceeds into a trust or an escrow account. These are proceeds from IPO. Okay. And after 2 to 3 years, once they finally, they have cracked a deal and they have finally decided to do the merger and acquisition, then they will acquire a target company after taking due approvals. Yes, after taking due approvals from the majority shareholders, right? And till the time deal is finalized, money is kept in the escrow account or trust account. And they will also do the proper due diligence. Now they are called as the blank check companies. SPAC companies are called as the blank check companies. Why? Because it's simple, right? I'm just issuing the blank check to the SPAC, that whosoever they want to, let's say, where they want to invest, they can invest, or whosoever they want to put a name as the money will be utilized there, they can do that. However, practically, they will have to seek approvals from the majority stakeholders. Yes, Abrikesh, such IPOs are allowed, because in the prospectus that is filed for such IPOs, it has to be mentioned that the objective is the SPAC, and they will be finalizing the deal. Until that time, the amount will be kept in an escrow account. Okay, very much allowed. There are proper legal regulations around it. Okay. So I think we have till now covered the entire part on the mergers and acquisitions. Now, students, in case you have any specific query on any specific practical question, please do let me know. We can, go through that from the assignments that we have solved in our regular classes. In the meanwhile, let's take a break of 10 minutes as well. Post that, we will start our startup finance and do the revisionary aspect there. Okay, so let's go for a 10 minutes break, students. Thank you.
Technical team.
Sorry, sir.
Ayaz,
Yes, sir.
Mr.
Yeah,
Next.
Mr. Ayaz, we can go for the break. Yeah.
Ayazji, I am not unmuted.
Uh, Abrikesh, you want to say something?
No, sir, I am telling that my screen, I mean, I am not unmuted. Generally, while lecture, students are not allowed to unmute themselves. I can
Okay,
unmute myself. I mean, I
okay,
think
okay,
settings should be changed.
okay.
Thank you, sir.
We will get it done. Thank you, sir. Thank you.
Yeah. Thank you. Sure. So welcome back, students. Let's continue with our discussion on startup finance. Right, we will take this part now. So first of all, students, we need to understand that what is exactly meant by a startup, right? Because there has to be some legal definition, there has to be some black and white definition which will help us to understand that what is the meaning of startup. So government of India has issued a notification wide which they have tried to put what are the preconditions for a startup to be. So, first of all, the startup needs to be either a private company, private limited company, or a registered partnership firm, or a limited liability partnership. It can't be a public limited company. It can't be a listed company, right? It has, and the primary reason is because it has to start with a small scale, right? A small scale starts either with the limited liability partnership or a registered partnership. And the reason why they've kept um, you know the sole proprietorship also outside this is because there is no separate registration, right? So it's up to that individual. So hence, if let's say a single person wants to do, he or she needs to float a private limited company, right? So that is one. This is the legal form of the startup. This constitutes as the legal form of startup. Okay. Then the second precondition is that that 10 years from the incorporation should be going on. It should have not been elapsed. So let's say a company which is a private limited company is already into its 11th year. Then the moment it crosses 10th year, it will not be eligible for being as a startup, right? So this is the second condition. So it should be within the range of first 10 years of incorporation. Okay. Then third is the turnover should not exceed more than 100 crore, because the moment it exceeds turnover as 100 crore, that means the company is not a small company anymore, right? I mean, it is doing business which is generating revenues more than 100 crores. So it might end up having a not being a startup, right? And by the way, why we are reading this definition is because if you are eligible as a startup, then you will get certain incentives, subsidies, or benefits from the government, and hence government has finalized this definition. Okay, so one, it has to be a private limited company, registered partnership firm, or LLP. Second, it has to be within the 10 years of its incorporation. It should not get beyond 10 years. Third, the revenue or the turnover should not exceed 100 crore in any of the year. Fourth, this is very, very important. It should not be formed as a split up or a reconstruction of an existing business. So students, in our previous part of the today's session, we have discussed about the mergers, acquisitions, and corporate restructuring, where we discussed about the devastator. In the devastator, we discussed about the split ups, right? About the spin offs, about the demergers, right? So, all those things should not happen while we are looking for a startup definition. If existing businesses are reformed using a reconstruction or a split up, then it is not going to be eligible. It has to be a clearly separate business and registered turnover up to 100 crore within 10 years. Then it is going to have a impact on the under the startup. And the last part, this is the main operating part of the company, right? Now it says that, let's say any person goes and just opens up a restaurant, simple, and they open it up under a private limited company. The turnover is also up to 100 crore. They are in the first 10 years and they have opened up a new business of a restaurant under a new brand name. So is just opening up a restaurant enough for being qualifying as a startup? The answer is no. Because in that restaurant, you are not applying any of the innovative ideas, any of the new products or the new innovations that are happening, right? So, so this is the main operating principle for any startup to qualify a startup. Okay, what is this? First of all, there has to be an innovation, there has to be a development, or there has to be a deployment, or there has to be a commercialization. Okay, so one is that thinking about the idea, second is developing that idea, third is implementing that idea, and fourth is selling that idea, right? I hope all the four things are clear. Of what? Of any new product, any new process, any new service, right? It can be any product, it can be any process we mean, let's say, any technological process. If there, let's say, there is a breakthrough innovation in one of the technological process and the company is actually giving that process re-engineering or restructuring as a service, then it will form as a startup provided other conditions are fulfilled. And it has to be driven by technology or intellectual property. This is actually very critical condition, because if these things are not there, I mean, you can do any damn thing, but it will not lead to the startup definition, right? Hence, this fifth point is the real distinguishing point from the operational standpoint of a company. So they have given you many things, right? They have said you make use of technology, you make use of any intellectual property. However, you do any sort of an innovation, development, deployment, or commercialization of any new product, process, or service. Even service they are including, even products they are including, and even process they are including, right? So if you satisfy all these 1, 2, 3, 4, 5 conditions, then you will be referred as a startup. And the moment you are referred to as a startup, as per the definition of Government of India, then you will be eligible for furtherance of the benefits or incentives that are there. Now, students, we have to discuss about since we are talking about the startup, the biggest problem with the startup today is the way of arranging the funds, because it's not easy for a startup to finance the required funds. Now, what are the innovative ways to finance a startup? Again, I'm saying these are the innovative ways to finance a startup. There are other ways as well, but these are the innovative ways. Because if the question asks you what are the innovative ways to finance a startup, all these things will come into the listing. So the first innovative way to finance a startup is a personal financing. Personal financing, we mean that at a personal level, if we are holding some of the savings, right, some of the savings that we can invest it into the startup, that is personal financing. Second is personal credit line. So the credit cards are issued to an individual, right, or to a corporates also, but we are talking about the personal credit cards here. So the personal credit lines represent those forms of credit that are given to a individual in his or her individual capacity, and they are using such personal credit lines to finance a startup. Okay. The third is friends and family. So sometimes what happens, they will make use of the requirements from the friends and family in terms of the informal borrowing, students, right? Peer-to-peer lending. Now what happens, this is some form of a I know whether you have heard of not, but they will, let's say, form a peer group in which they will keep on contributing, let's say 12 installments, and one installment at one time for the entire 12 amount they can take out for their usage. So this peer-to-peer lending is more akin to the, let's say, the chit fund, right? where you contribute, you create that corpus, and whenever you need, you can draw out your requirement and you can make use of the funds, right? So peer-to-peer means all the peers there will be who are having the requirement to borrow, right? Crowdfunding students. So this is also one of the new idea how funding happens. So imagine there are, okay, let me just put it here. So I'm talking about crowdfunding here, students. Okay, so imagine there is a platform here. By platform, I mean a website, okay? E-commerce website, for example, right? Now, this electronic website, there are thousands of small investors. These we call as crowd, right? As the name suggests, this is the crowd. These are actually thousands of small investors that are there. These are called as crowd. Now they register themselves into this website. There are some different businesses also that gets them listed on this platform. Sorry. So they need funds, right? They have funds. So what they will do with all these cases, let's say this is case 1, case 2, case 3, case 4, like this, there will be different business cases that will be listed on the website. So this crowd, what they will do, they will go one by one, see the cases, and when they want to invest, they will put small amounts in the investment in those cases, business cases. For example, they can even put up, let's say 500 rupees as investment. Okay. And these businesses will get money. Now, if you imagine thousands of people contributing even 500 rupees will make up a big amount, which is 5 lakh rupees, right? So in a way, crowdfunding is also one of the startup ideas, right? Because there are different platforms who are into the crowdfunding. They source smaller amounts from the crowd, make it as a big amount and invest into those businesses. Now, these businesses also will have a owing to such crowd, right? So this is what crowdfunding is, students. Now let's come to microloans. So microloans is again the informal way of borrowing. Let's say in the market there are some informal, loans that are available at a higher rate. Let's say at 18% or 24%, not from the banks. So these are coming here. Vendor financing, students. See, vendor financing happens when we have, let's say, agreed as a business with a vendor, let's say 30 days, right? Now we understand that within 30 days, it is not going to be possible for us to pay the amount. Hence, what we will do, we will ask them to extend the credit, right, from 30 to 45 days. By doing so, we have postponed our cash outflow by at least 15 days. And we have enjoyed that 15 days credit in terms of the financing to allow us more time to pay them back. Purchase order financing. So in purchase order financing, the amount is received once we receive the PO. Because once you receive the PO, that means a valid commitment from the customer's part to purchase the goods. That means the person who is selling the goods can borrow basis those purchase orders, do the preparation, do the FG is done, and then it can send back the goods. Then the ninth part is actually factoring accounts receivable, right? In this, what happens? By factoring, we mean whatever receivables are standing in our books, we will get them encashed today, right? We will get them encashed today with the help of some agency, and that agency will charge some commission to us. Let's say 90% of my debtors, I give it to that agency pay me 89% of the amount, 1% they keep is their commission, for example. And balance 10% they say that we will keep it as contingent. Whenever there is a chance of receiving it, you receive it directly, that's okay, right? So factoring will mean that you are, if let's say from debtors the collection has to happen within 60 days, you will do that collection as on today through the factoring, and you will realize the funds as on today. So from 60 you have reduced your basis. One is the recourse basis and second one is the non-recourse basis. So recourse basis is the process wherein we end up having entered into an agreement where in case the debtors fails to repay back the amount to the agency, right, then the agency can claim the amount from us. And non-recourse basis means that agency will not be claiming it back from anyone. It will be a dead loss to the agency, right? But in this case, there are discounting charges, there are commissions that are applicable, there are added costs that are applicable, and they might be different for a recourse or a non-recourse basis. Perfect. So this is what the innovative ways to finance a startup was, right? Then there is a concept of unicorn, students, right? What do we mean by unicorn? So you would have heard in practical life that a startup is successful once it becomes a unicorn. So as we say that every startup, has to be valued, right? Because this valuation will give the person who is selling the stake and even the person who is purchasing the stake that what is the right value of that business. Let's say 1% stake is going to be purchased, 2%, like that. So in a way, the unicorn concept is based on the valuation of the startup. If they say that the startup's valuation crosses USD 1 billion, 1 billion we are talking about, okay, then it becomes a unicorn. So let's say somebody says that $300 million is 20% share of that unicorn, of that startup. So that means the full value becomes 1500 million, right? Which is 300 divided by 20%, which is the share. So 1500 million is becoming 1.5 billion. Okay, this is the concept of unicorn. The moment somebody says that they have turned into unicorn, that means everyone has a perception that they have reached to a higher level. Okay, now this is what unicorn is. Now we have to also understand that there is a pitch presentation that happens from startups founders side to the investors side, right? Now students, please focus. This pitch presentation is actually presented to investors asking for money, right? And it explains about, let's say, the product, why the company was established, what is the idea behind that startup, what is the objective behind that startup. All those things will come into that pitch. Now it has to be put in some reference, right? It has to have some basic pointers so that knowledge level for this pitch presentation, what all things you want to cover? One, you would want to cover the introduction first of all, right? Introduction about the startup, introduction about yourself as a founder, right? Because see, startups works on two things, right? One is founder will have an idea, they will want to execute that idea, and hence that will come into the startup ecosystem. And second is definitely the investors who would want to grow that idea along with the founder, correct? So in a way, you would want to introduce, we would want to include a introduction para. Then the second para will be team. Is not having very large amount of teams initially. They have very handful of people depending on what is the requirement. So they will. So the next step is to introduce the teams, right, who are helping them in the overall process of setting up the startup business there, right? Then third part. So students, if you see third part, as we said that startup needs to do some sort of an innovation of any new process, right, product or service through some technology, correct? Now in a way, if those things needs to happen, there has to be some sort of a real problem in society exists which their startup is able to solve for, right? If you see any business, any product, there is some utility of that business, there is some utility of that product from that business, right? So it tries to solve for some problem that you are having, right? So similarly, startup, the way it should be operationalized is that it has to include some or the other problem statement that the startup is going to solve for the problem. Okay, so it has to tell that what problem the startup is going to solve for. Then third segment that can be included is solution. For this problem, what is the solution in hand, right? How are they trying to do the troubleshoot of this problem? And this solution should be scalable, it should be implementable, it should be scalable, so that tomorrow if it gets hit, it can be scaled up to a very big level. Then comes marketing and sales related functions. So in a way, in your pitch, you would also want to tell that, what is really the market size of this product, how much, growth in that market is expected, what is the size of business that the startup can do initially, right, in the overall market, what could be the likely market shares of the company, like that. Then, being from finance, this is very, very important. Projections or milestones. Projections of what? Projections of P&L, projections of balance sheet, projections of even cash flow. How much cash will be needed initially, right? How much cash will be needed? The balance sheet, how healthy your balance sheet will be. So all those projections are also part and parcel of the pitch statement, of the pitch that is going to be prepared, pitch presentation. Then we also need to include some of the pointers related to competition, right? Because to be aware about what competition holds will enable you to deliver better. And in case, let's say, any of the recent competitions, acquisitions that are happening, right, with what scale and with what objective the same is happening. Then let's come to the business model, right? It's a wide term actually, which denotes the all the core aspects of businesses, which, let's say, include the business process, let's say who will be our specific customers, what is going to be our strategy, what is going to be our pricing, what is going to be our channels through which we will be selling, what is going to be our trade practices, all those things will come into the competition. Sorry, all this will come into the business model bucket. And lastly, investors will also be interested to know that from where are we arranging our funds, right? Is it through the innovative ways that we discussed, or is it through a new ways that we are going to discuss? Okay, so unicorn we have discussed. Yes, now let's come to the modes of financing for startups. So students, in this pitch presentation, there is nothing new that we can think of, right? Even if somebody asks us also to make a pitch presentation for something that we are going to share it with our investors, we will include probably almost all these things, right? Then modes of financing for startups. Bootstrapping. Okay. Now, bootstrapping is actually utilizing internal sources of finance, right? So basically, whatever is available internally within a company, if you scratch that and take out the benefit of it, that is called as bootstrapping. Now, there are three sub points of bootstrapping. One is trade credit, factoring, and leasing. Now, what exactly is meant by trade credit, students? Trade credit is again asking a vendor to basically increase the credit period. Vendor is selling the goods to us, right? So we ask them that, hey, listen, we are startup, and hence, if you let's say can offer instead of 30 days, 60 days credit to us, we will be able to meet that obligation. But sometimes this comes with the cost, because the moment you ask for a higher increase in the credit period, the the vendor will ask for higher charges also. So it has to be balanced in such a way that you don't lose, but at the same time you are able to stretch to the maximum credit period allowed from the vendor. So this is a trade credit available internally, available within your system, available within your value chain, that you can make use of it, and hence this is called as bootstrapping. The second part is called as factoring. Now this factoring is basically the part where we discussed, right? Accounts receivable factoring, where whatever receivables we are having, we can sell it to a factor who can give us money right away, and he or she can charge some commission. Later on, once the collection comes, it can go to that factor. Again, it has two bases: recourse and non-recourse. Okay. Then next part is leasing. So leasing, generally what happens, if let's say you open a new office, right, you end up investing heavy amounts into the furnitures, into the laptops even, right, into the buildings, right? So leasing helps you to access such capital assets without investing the entire amount initially, by just paying the lease premium. That's all. That is called as leasing. So trade credit, factoring, and leasing. Now leasing, you end up paying the lease rentals, right? Instead of doing the entire capital investment right away, you end up taking the lease rentals. Right. And later on, let's say once you have good amount of cash flows, then you can also think of purchasing the asset, right? Rather than leasing it. But leasing initially is a good option. You will end up paying only rents, not the entire blockage of the capital. Then second is angel investors, right? As the name suggests, this is also one of the mode of the financing for startups. So as the name suggests, students, angel is someone who comes as an angel and protect the startup from, let's say, scarcity of the funds. Now, angel investor is someone in the network, right? Whom people know, whom the founder know, right? Formally, informally, and this person will invest behind the idea, right, of the co-founder or founder, and hence they will expect. I think they will not expect a return on the amount that they're investing, but they will expect the business to grow, right? So these type of investors are called as angel investors because they come as an angel to serve to protect the business. So bootstrapping, trade credit, factoring and leasing, part of all bootstrapping. Second is angel investors. Now third is venture capital. Okay. Let me put in a new chart the venture capital. So hear me out, students. Okay, this is going to be a critical discussion for next some time. So as you understand, there are two types of company. We know that there is a company called public company, and the second category is private company, right? So public company is listed, right? They do IPO, they do FPO and other things. Private company is not listed, correct? Now, the equity invested through above mode, right? Wherein, let's say, the sourcing will happen, like the prospectus is there, listing is there. So equity invested through the above mode is called as public equity. However, equity invested privately, equity invested privately without, going to the public at large, without going for a subscription, right? The entire process. If equity is invested privately, then this is called as private equity. So this private equity is a different industry altogether. What do they do? So the private equity industry, they are responsible for investing privately into the businesses. So they identify which all businesses they think have such ideas which can grow later on, which have the amount of potential, and hence they will end up investing in a private mode, and hence we call them as private equity players, right? So venture capital, now let's understand the term venture capital. Private equity term is clear, students, I hope so. Public equity is clear, right? Public equity is just a reference, but private equity is what we will use. So this is also called as PE. So a lot of equity investments in all the startups happens through private equity these days, right? So venture capital is one form of private equity. Okay, so venture capital comes under private equity. Now, what is venture capital? Venture capital is where this is a PE firm, private equity firm, okay, which specializes into the investments on account of private equity. So they float a trust. Okay, they float a SPV in the form of trust or LLP. Okay, limited liability partnership or trust, they will float a SPV, special purpose vehicle. Okay, and they will appoint general partners. Okay, who are general partners? General partners are basically the people who manage this SPV. Okay, they manage the SPV and they get some commission, or let's say they get some percentages. And then there are these investors, which are, let's say, pension funds, corporates, right? HNIs, high net worth individuals, banks, financial institutions, right? Where all this money sits, right? The bigger chunk of money sits, they all are called as investors or limited partners. These we call them as limited partners. Okay. Now this SPV that is formed by the PE firm, it will get funds, right? So these are the funds, let's say. And these general partner students will be appointed by the PE firm to the SPV, right? They are generally the partners in the PE firm. So these general partners represent the PE firm. Okay. Then there is one manager who is appointed. Also called as advisor, whosoever name is called. So the role of this manager or advisor is to evaluate different investment options. Let's say they are evaluating 3-4 companies, right? 1, 2, 3, 4. So this manager or advisor will go through the details of each and every company, right? And hence it will recommend the investments in such companies to general partners or limited partners, right? In a way, general partners, it can recommend, yes. General partners will take a decision, right? And they will invest into such companies. Then this investment will okay. Clear, students? So this is the entire process of venture capitalists, in which this SPV actually acts as a venture capital firm, right? Or this PE firm, which floats this SPV, is as good as that. Now the general partners will get a commission, limited partners will get the return, the actual return that is happening because of these investments. Okay, students? Now let us see this. So these are the decision makers, general partners. It is held in the form of trust or LLP. So this SPV will invest amount, pool of funds they will create, and they will also manage the overall governance of the pool of funds. This manager, advisor, or administrator will keep such funds, and hence into the different options that are available, they will invest, right? Now, there is buying, growing, and selling, right? So they invest with 3 objectives. One is, first of all, they will buy, they will invest. Then they will not act as a passive investor. I mean, whatever company is doing, we will not get into the daily affairs. So they try to get into the daily affairs. They intervene so that the growth comes because they have expertise. So they will sit on the board of the directors, right? So they have that expertise. They will guide the company, right? And hence they will attention, they will grow, right? And they will grow multifold. So in 5 years, let's say they will grow it 7 times in terms of the valuation. So 1,000 will become 7. So first is buying, then growing, and then selling, right? And this is done to make sure that they are grabbing the right opportunity, and hence they are capitalizing on the same. And this invest is actually happening on a horizon of 5 to 10 years, students. Okay. Now let's talk about some variation in the venture capital in the form of domestic structures. So there are two structures that are there for us to study for the VC, venture capital. Structure are offshore and unified structures. So there are two structures, offshore structure and unified structures. Now, what do we mean by offshore structure? This SPV that we are talking about is outside India. Offshore means which is not on the legal domestic territory of the country, right? Offshore means outside the country. So here offshore is this SPV is outside India, right? But the manager who evaluates the investments, or let's say who evaluates the proposals, is based out of India, and the investments also will happen in India. Okay. In a unified structure, the SPV is outside India, which is fine. The investors from India and investors outside India both can do the pool of funds, which is in the form of a trust based out of India, and then they will invest in India. So this is called as unified structure. Okay, students. Any questions till now? Okay. Okay, Abhikesh. So offshore and unified structures are like this. Then we have discussed about private equity and public equity. These are placed privately. These are placed through an IPO. Yes. Now let's come to the succession planning in business. So let me just open the. Okay, first before going there, for venture capitalists, for venture capital financing, we also need to understand what are their characteristics, right? So one is that they have a long-term horizon, right? As I said that they typically invest for 10 years, right? For a period, let's say mentioning from 3 years to 10 years. Okay. Long-term horizon is, let's say, 3 years to 10 years, right? And there is lack of liquidity, right? So in a way, they also understand that whatever amount they are investing, they will not be able to get it back, right? So because it's not because if let's say today you want to invest in the share market, you invest today, and tomorrow if you want to reap out the liquidity back, you will just sell it and get the amounts back. But in this case, there is nothing like that. So there is a lack of liquidity, right? You will be hard on liquid funds. You know that you will not be able to get back the amounts that you are investing. Then third is there is a high amount of risk. There is a very high amount of risk. Why? Because tomorrow, if let's say the business fails, it's a new business, right? Then your investments might go down, right? And fourth is actually equity participation. So equity participation will be, let's say, investing in the form of equity, not in the form of debt, right? and then only the real valuation benefits will flow to the venture capitalists. Okay, now let's go to the succession planning. Okay, now students, the succession planning in business is really, really very important. Okay, why? First of all, there has to be a risk mitigation. Correct. What is the risk? The risk is, if let's say today the leader quits, then there is no leader to step into the position of that leader and take the organization running. Okay, see, first of all, what is the basic, what is the basic, let's say, objective behind putting up a leader? Because that leader will have that vision, will have that strategic direction, will have that overall binding force for the company, right? So if that person decides to quit, then there is a risk that the organization will become directionless. There will be more uncertainty, and hence to avoid that, there has to be a proper succession planning. Second, there is cause removal. Cause removal means that there, if as per the Companies Act or as per some other act, if the person is found guilty of some gross negligence, fraud, willful default, then also the removal will happen, and hence there will be no other person who can take over the leader's profile. Third is talent pipeline. So there is a strong need for succession planning in businesses in India, because there are huge amount of workforce that is available. So to keep them motivated, so to keep them upskilled, there needs to be a proper vision of the career path, and hence for creating a proper talent pipeline, there is a need for a succession planning. Okay, then there will be a proper conflict resolution mechanism in case the succession planning is there, right? Because then there will be no ambiguity. Then there will be no ambiguity, and the person who will be a successor of a family-owned business, it helps to align with the culture, vision, direction, and the values of the business students. Okay. Now, how should we do the business succession strategy? First is we have to evaluate that what are the key leadership positions, right? In a company, what are the key leadership positions? Not all positions will need a succession planning, right? But those roles which are very critical, let's say CEO, CFO, company secretary, all those are very crucial positions which will bring some kind of a transformation. Then second is, once the positions are identified, we need to map what are the competencies required for the above positions, right? What are those skill sets that are required to match to those above positions? Then third is, we have to also identify that current workforce is at what level, right? So see, first of all, this is identifying the leadership position. Then this is the required state. Required state. This is the current state. And then finally, this will become the bridge leader, right? So bridge leader means a person for the time being is acting as a leader till the time the final successor comes and takes over the roles, right? So this is around the strategy. Then there are some challenges also, right? Now, what happens? There is a corporate mindset and there is a founder mindset. So the founder's brains works in a way that they can take higher risks, right? They want to grow fast, right? So in a way, you cannot plan to succeed a founder, right, of that startup. Then second is, for startups to implement business succession planning, they need to involve, let's say, huge amount of efforts and costs, which essentially is not part and parcel initially for the startups to run. Then The third part, for any startup, founders become the face of that startup. Now you cannot imagine and try to succeed that person from the startup. Okay. So basically, in a way, what we are saying is succession planning is really important for the businesses, but it is more inclined towards the established businesses compared to the startups, because startups will not have that bandwidth, will not have that cost or efforts, timeline to complete the succession planning. But if you don't do it, then you will land up yourself into a lot of risks, which needs proper mitigation. So students, let's come to some of the MCQs. Right. So this brings us towards the end of whatever topics we discussed in the morning about the mergers, acquisitions, and corporate restructuring, along with the startup finance students. Again, I'm asking if there is some any other question that is unresolved. You are very much free to put it. We can discuss that, right? So till that time, let's try to get to these MCQs so that we test our knowledge that we have discussed today. So question number one, students. In dash mergers, this is a tricky one, okay? I can tell you a lot of you might have some confusion in this, but read this very carefully. In dash mergers, the acquirer and target companies are related through basic technologies, production processes, or markets. They are related. Please read each and every word very carefully, students. Come on. Abrikesh has responded. Okay. Let me see on the question handle if there is someone. No. There is no response. I request if someone is watching outside Zoom also, please you can respond on the query handle the questions. So we will wait for 30 seconds for the responses to come, then we will reveal the answers accordingly. So question number one, it says, in dash mergers, the acquirer and target company are related through basic technologies, production process, or market. Abrikesh, you want to change your answer or you want to stick to what you have discussed, what you have said? The options are horizontal merger. I am again repeating what is an horizontal merger. It's a merger wherein it belongs to the same industry. Vertical merger, customer or supplier. Conglomerate merger, diversified business. Co-generic merger, which has the same generic. These are belongs to the same family, I can say. And hence they have a relationship. They are related. I'm just giving you a lot of hints. Okay, let me reveal the answer. So this is co-generic merger. The right answer is co-generic merger. Reason being that it is mentioned as these are related through some form of basic technologies. Through some basic technologies, production processes, or markets. They are related. See, it is clearly mentioned they are related. They don't belong to the same industry, right? In case they mention that they belong to the same industry itself, then it is a horizontal merger. Okay, clear? Then let's come to the second question, sorry. A dash is the sale of an asset, factory, division, product line, or subsidiary by one entity to another for a purchase consideration payable either in cash or in the form of securities. So selling these things by one entity to another for a purchase consideration. Think and then answer, students. Again, come on. This we discussed today in detail. So, where you take your business out and create a new company for that business, right? That is called as spin-off, right? Split up, where the existing company is liquidated and you create different new companies. Equity carve out is issue of equity shares along with spin-off, and sell off is where you sell the assets, business units, or any other major chunk of things. So this sell off we discussed in detail, and this is a question for the same. Now, okay, let me see who all have responded. Okay, yes. So this is true. This is A. Abrikesh, you are correct. Meanwhile, I request the technical team to please open the session for students to ask verbally the questions in Zoom itself. Okay. Meanwhile, technical team can do that. Then third, an acquisition of a company or a division of another company which is financed entirely or partially using borrowed funds is termed as. This is also what we discussed today. So we are saying that if we acquire another company or a division of another company, and the source of such funds comes from borrowed funds, then we call it as a management buyout, we call it as going private, we call it as equity buyback, or we call it as leveraged buyout. These are called as LBOs and MBOs. MBO, LBO. So LBOs is basically leveraged buyouts. So management buyout was something wherein the management takes over. Going private is where you purchase and hence you go private. Equity buyback, similarly, you are buying back your stocks. And leverage buyout, where is LBO. So let me wait for another 15-20 seconds more if somebody else wants to answer. Abrikesh has responded. Just a second. So yes, Abrikesh, you are right. The correct answer is D, leveraged buyout. Okay, because we are saying that it is financed entirely or partially using borrowed funds, right? So that is why it is called as a leveraged buyout. The main objective of Dash is to raise money despite not having any operations or revenue. The money raised from public is kept in an escrow account which can be accessed while making an acquisition. So in this case, what is the right management buyout or special purpose acquisition company? The question is very simple. If you just read the requirement, the main objective of Dash is to raise money and it is not having any operations and everything, and it is kept in an escrow account till the time a decision is made for an acquisition. So I think I have got a response from Abrikesh. Yes, this is The correct answer is special purpose acquisition company. Your answer is correct, Abhikesh. You're right. Special purpose acquisition company is the company which will accept the funds and keep it in escrow account for any usage later on. So question number 5th, dash is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself. Now this is interesting actually. Let's see. This is a tricky one. Please think and then answer. Dash is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself. It is looking a bit tricky. Is it personal financing, customer financing, vendor financing, or bill discounting? So this is what we are saying. Let's say A Limited, B Limited is the customer, right? So that in which a company, a company is, let's say, A Limited, it is lending money to one of its customer so that he can buy products from the company itself, so that this customer can buy the products from A Limited. Agreed? So again, I'm saying A Limited seems to be a vendor then, okay? A Limited is a vendor, B Limited is a customer. A Limited is lending some money to B Limited in the capacity as customer, and then customer can buy products from A Limited. Now, what is this? What is this sort of a financing called? Is it, see, clearly I think it's not personal financing, but between these three, it can be customer or it can be vendor. But customer financing, we really think that it is a customer financing. So customer financing does not mean that we are financing to our customer, right? Customer financing basically is when you are doing your factoring, when you are, whatever is receivable to you from your customer, you are realizing it early. However, vendor financing is where the vendor helps to the customer in arranging the finances and hence to complete the order. So the correct answer here, students, is wait, let me see. Abrikesh has responded yes. Any other answers? No, as of now. So it is vendor financing. Okay, the correct answer is vendor financing, Abrikesh. Okay, because it's from the vendor. Okay, so that vendor is benefiting, vendor is assured of the sales happening to the customer, and the customer is also assured of getting the required support in terms of the working capital. Then question number 6, students. Which of the following is not a precondition for qualifying as a startup as per the notification released by the Government of India? Please read it carefully again. Which of the following is not a precondition for qualifying as a startup as per the notification released by Government of India? Is it incorporated within last 10 years? Is it turnover not exceeded rupees 100 crore? Publicly listed company or innovation of products or processes? What should not be there? Or let's say we can first of all see what all things are there which satisfies the definition of startup. We can revise it quickly. Let's revise it. One, it has to be a, okay, on the legal form we will come later. Second, it has to have been incorporated in last 10 years. Yes. It has to have a turnover of up to 100 crore. Yes, it is having. And it has to carry out some sort of a innovation, and it has not to be formed through some sort of a split or reconstruction. Correct? That is what all things we have studied. However, it cannot be a public listed company. It can only be a private company. It can only be a registered partnership firm. It can be a LLP. So only from these three the correct answer will be there. So it says not a precondition. Publicly listed company is not a precondition for startup being there. So Abrikesh, your answer is correct. Abrikesh or any other student have any other doubts left from the topics that we discussed till now? Please feel free to verbally ask or to put it on the chat wherever you want. We will discuss that. Okay, Abrikesh is asking, please unmute. Technical team, can you please unmute Abrikesh?
Good morning, sir.
Yes, good morning, Abrikesh.
Sir, my question is regarding post-merger EPS,
Okay,
where I mean we are multiplying the post-merger EPS by swap ratio to know whether these company share of merged I mean shareholders of merged company have benefited
perfect,
or not. Now, sir,
perfect.
what I want to ask is when the price of A, I mean market price of A limited is already more than that of B limited share earlier share, then why I mean shareholders should know whether it is beneficial or not, just to make a apple to apple comparison.
No. See, I'll tell you. Okay, let's take an example where you're saying that A Limited's market price is higher
Post merger.
than B Limited's market price. Correct? That's what you are saying,
No, not that. A post merger EPS
right?
for the A limited is already more than the pre-merger EPS of B limited.
Okay,
Now,
okay, okay. You're saying
I'm
okay,
asking about the absolute amount. No, sir?
okay. So you're saying post-merger EPS of A Limited is greater than
Greater than
pre-merger
pre-merger EPS of B limited.
EPS of B Limited. Okay,
Yes.
clear.
Now, my question is why, in that case, why we should multiply post-merger EPS of A limited
I'll
by
tell
the
you.
swap ratio,
Yes,
just to
I'll tell
make
you.
apple-to-apple comparison?
Yes, just to make apple to apple comparison. If you don't do that, I'll tell you why your analysis will go for a toss. I'll tell you. For example, let's say the swap ratio is 0.10 is to 1. Okay. What does this mean? The swap ratio in purchase consideration that has come is that for
One share
every
of B
one
limited
share,
will get 0.10.
yes, one share of B Limited will get 0.10 share of A Limited. Correct?
Yes.
Now, assume here post-merger EPS of A Limited is let's say 50
Yes.
and pre-merger EPS of B Limited is let's say 20. Okay.
Okay. Yes.
This is 50 is greater than 20. Now, the moment you you compare this 50 and 20, it is going to be wrong because you are not taking into account of this factor that this out of this 50 only 0.10 belongs to the B limited's comparisons,
Okay.
right? So this is let's say 5.
Okay.
Now this 5 has to be compared with 20. Now in this case, if you see the
Okay.
analysis will get
Yes.
reversed, right?
Got
Now
you.
you will say that 15 rupees there is a loss
Yes.
because earlier it was 20, now it is 5. Okay.
Okay. I got it. Thank you, sir.
That was a good question, Abrikesh. Appreciate your thought. Thank you. So thanks a lot, students. So this was it from my end. Now I hand it over to CA Ashish sir for his concluding remarks. Thank you, sir. Thank you, everyone.
Thank you very much. Technical team, just Devas, just to stop sharing your screen so
Sure,
that
sir.
I can.
Sure, sir.
Yeah.
Just a second, sir. There is yes, yes, sir.
Okay, student. Yeah, I think 1 second. I just share my screen. Hmm. Is it visible? Yes. Yeah. Okay.
Yes, sir, visible.
Now, to further explain this Mr. Abhikesh's answer, just I'm saying, sir, your question was very right. However, I will also supplement saying that there is another term called bootstrapping. Now, you will surprise, bootstrapping has been discussed under the topic of startup finance. Now, I am also supplementing, it is also linked to the merger and acquisition, how it is linked. I'm just sharing with you. Now, say there is a company A Limited, another company is B Limited. I'm taking same example. Okay. Now, what happens is it may be possible that A's share limited share price is more. Okay. Say you are saying it is somewhere around 100. Okay. Market price. Its market price is 20. Okay. Now, when both companies A Limited acquires B Limited, of course, it may be possible that post merger, it may be possible. They may be possible that earlier their EPS may be 5, but now they may EPS have a 2. But what happens? This company may have a higher PE ratio, very high. Okay. Now it may be possible that when we multiply PE ratio with EPS, higher PE ratio, because after post merger, the PE ratio of the acquiring company will prevail. So it will be benefit to the shareholders of the acquired company, B Limited. That is called bootstrapping effect. I think Abhijit sir, you are clear now or more. Okay, I think he will join us. Okay, students. So now this there is another I am supplementing to the discussion of Divas sir. Divas sir, you have rightly pointed out now it is merger acquisition taking the variety of forms. Now, of course, there is some new terms have been introduced like strategic alliance. Okay, like you were quoting like that, a company may not be interested in acquiring the overall the company, but they are interested in the acquiring only one division, B1 that you were quoted. Now there is
Yes,
another
sir.
kind of a form
Yes.
where it is called strategic alliance, where they take the knowledge apart from the company. Okay, they pay to the company and they work for they acquire their knowledge part, or you can say you can say learning analysis kind of a thing, or we can say their correlation type of a thing, or some specialization thing. So normally they may say that okay, you gave us this much of your domain area of knowledge, so like that. So this kind of another merger acquisition form. Of course, it is somewhere kind of a you can say it is a kind of a joint venture, but in a joint venture, normally the two companies combine together and created temporarily a new entity. But here, no new entity is created. Okay, that is a one important consideration. Second thing, while when we talk about the merger acquisition, so merger acquisition creates synergy. Okay, what do we mean by synergy? The value of A plus value of B is less than of value of A and B combined. This is called synergy effect. Okay. Of course, when we talk about merger acquisition, it is always said it creates synergy value for the both the companies or the acquiring companies. But there is another term called demerger that is now gaining a popularity also. Now the companies are getting their business division. Demerger is now becoming. See, there are like spate of the merger acquisition. Now there are the spate of the demerger as well. Now question arises, why this is demerger? Now, while merger acquisition creates synergy benefit, demerger creates value creation. Because sometimes a company may find it difficult to manage the overall businesses. Okay, so they may think, okay, we demerge the business so that they can concentrate on one core business, or other business will be independent, operate independently. So this is called value creation. So it is also very important. Divas sir, correct me if I am wrong on some place.
Sure, sir.
If I am incorrect on any,
No, not at all, sir.
getting corrected.
No, not at all, sir. Not at all.
Okay, okay. So another I want to discuss with the startup finance. Now, when we talk about the startup finance, uh, there was an I will like to supplement like you were talking about how they manage their business, like leasing. They are taking the generally you can hire some office area for some particular days. There you can get, say, I want to have a 5 tables, okay, 5 workstations. Like you can kind of arrangement. So these are kind of a as per your requirements. Suppose if you have got a contract, okay, you are planning that I have to complete the project in a 6 month. So in that case, what happens? For the 6 months, you hire the higher space, more than space. After 6 months, you leave the space. So this kind of a new concept has come into the picture. And because my one or two friends, one of friends is in a startup, so I was just asking about their office. So they say we don't have any particular kind of location. Of course, we have a co-space there. So this is kind of another arrangement is also possible. Now regarding succession planning, recently I think there is one very good not no, I will not say good news, but it is a kind of a news like that. In a very renowned we can say conglomerate, in their succession planning, the issue is that their next generation is not ready to accept the business. They are more going into the, say, music or art kind of a business, so they are not that much of a flair. So now the succession planning importance has increased manifold. Now
Yes.
the for the family business, it is now more important how we continue this family business for a long time, because their next generation is not ready to take that much of stress level, we can say, or we can say entrepreneurship level. They are generally, they want to say they want to pursue their own passion like music, art, etc. So now that's why the succession planning and trust family trust businesses management are becoming important topic, and especially for the chartered accountant is a there's a number of opportunities are for them. Now with this, I am coming to the ending the subject part. Now, if you have any issue, so with this discussion about all topics, all 15 chapters have been covered up. We have covered. Now, I just before ending of session, just quickly, I am discussing the one examination pattern. Of course, student, before your all examination, we will have a mock test series. Okay, we will come out with the revised test paper for your November 2024 examination. We shall conduct mock test paper series. Okay, and even we shall also conduct videos for the success session, where we shall discuss the tips for the in very detail how you clear the exam. So all this we will cover there. Of course, you can continue to prepare yourself for the same. And in meanwhile, if you have any query, you can contact us. I will share in the end my email ID as well as my. But before that, I just want to share with you our paper pattern, question paper pattern. The students see here, it has a two parts. We can say division A, division B. Okay, it carries 30 marks. It carries 70 marks. Okay, it is completely MCQ case scenario, MCQ based. Means MCQ will not be independent, rather there will be some case scenario. Out of this, like MCQs will be generated, generated, and you have to answer. So there are will be 15 MCQs overall, and each carry will have two marks. So accordingly, they will 30 marks will be there. Of course, the number of case scenario may be vary from 3 to 5. Okay, generally 3 to 5 case scenario can be there. Now in the division of 70 marks, there will be descriptive as well as numerical questions. Okay, where the one question will be compulsory. Okay, and out of remaining, you as a question, there will be all 6 questions. Okay, out of which you have to attempt 5 questions. One question will be compulsory, and out of which one even in one question you will also be provided internal choice. That will be there in the one question. So this will be the pattern. Now here I would like to say that while attempting the MCQ, it is very important to note that there is no negative marking. That's why I am marking it with the red. I am marking it with very blue ink. There is no negative marking. So please don't skip any MCQ. Please attempt all the MCQs. Okay, because there is no negative marking. So student, with this we come to the end of our session live after classes AFM batch 2 for the paper Advanced Financial Management, where we have taken adopted a hybrid mode where all the students have gone through the recorded lecture and we have taken the present. Now student, with this I am just sharing with you my contact number. where you can contact me over the telephone. Okay, directly. We have a mobile app there. Of course, if you can contact us at this email ID also. So I would request students, please go through our study material. And in study material, if you find any inconsistency or any error, my request to you, please bring it to our notice. My sincere request to you, so please you bring it to our notice so that we can improve upon the same and future students can have a benefit of it. So with this, we come to the end of this session and to this journey. And we thanks C. Divas sir, because overall in this series, he has contributed a lot and enlightened us on the various important topics. And we can
Thanks a
say
lot, sir.
even
Thanks a lot, sir, for giving the opportunity. Thanks a lot, sir. Thank you.
yes, sir. Okay, students, and we also thank you and especially Abrakesh sir for their you can say dedication and even here I think he has never missed any single lecture. So we thank you from the core of from bottom of our heart, Abrakesh sir, and we will continue. You please continue to have an association with us so that it will be mutual benefit for us. Okay, students. With this, we come to the end of this session. Thank you very much.
Sure.
Have a
Thank
nice
you.
day.
Thank you.
Okay,
Thank
Devas
you.
sir. Thank you.
Thank you, sir. Thank you, sir.
Thank you. Technical team. Session is over.